our first panelist today has a very, very solid background in financial journalism. He has indeed been nominated for the UK 2006 Business Journalist of the Year Award, and he holds a Malcolm Forbes Award for Best Business Story from the Overseas Press Club of America. So please welcome, he's a columnist on global capital markets for Bloomberg News, but more important, he is the London Bureau Chief, Mark Gilbert. Now, our next panelist is a long-term journalist and edits mediachannel.org, as well as articles, commentaries, polemics, books, rants, and indeed documentary films. His recent publication, Plunder, investigating our economic calamity and subprime scandal, and he's also putting finalized touches to a documentary on the role of the media in the financial crisis. So we're all going to come under scrutiny from him. So please welcome, he is Danny Schechter, the news dissector. Now, we do have a great combination of international and local regional journalists here, and they come from all walks of life. And our speaker now, he began his career as a documentary researcher for BBC Television. And from there, he moved into print journalism as a companies writer at Investors Chronicle, and later he joined the independent newspaper where he became financial editor. But he is now with us today in his role as assistant editor for breakingviews.com, Chris Hughes. Our next speaker runs the audit for Columbia Journalism's Review's online business press section. And that actually describes itself, wait for this, as your guide to the business press as it scrambles to cover a global financial crisis while its own financial basis collapses. Ay, 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 ay. So we've got to watch this one here. He has written extensively and been published in high-profile newspapers, The Wall Street Journal, The Nation, and The Washington Post. He is the assistant managing editor and Kingsford Capital Fellow at Columbia Journalism Review, Dean Starkman. And our final panelist is indeed a seasoned publisher and an author. He has published 2 books, Prophets of Science, The American Marriage of Business and Technology, and Gene Dreams, Wall Street Academia and the Rise of Biotechnology. And he has also worked as a writer and editor for Forbes and Financial World and Institutional Investor. He is indeed the editor-in-chief of The Deal, Bob Teitelman. So there you have. What a panel here. What brains we've got right here in front of us. So I'm going to hand this over now to Mark Gilbert, who will start off this session. Thanks so much, Mark.
Ladies and gentlemen, I'm going to defend journalism. I'm going to defend financial journalism. I'm going to argue that we did see the crisis coming. We commented on it, we pointed it out, and all of the signs were there that this was going to be big, bad, and nasty. But all we do is commentate. We observe. We don't change the world. We don't make things happen. I'm going to direct you to the pictures at either side. This is a series of slides I did almost 2 years ago now, which I used in presentations to Bloomberg customers, so to investment bankers, traders, derivative specialists, hedge funds, investment managers, showing them in graphical terms that we were heading for destruction. And the presentation was usually called Scream If You Want to Go Faster. And they did a lot of screaming. So here's where we're at the end of 2006, risk measures. The white line is the VIX index, which is stock market volatility. The red line is a MOVE index, which is bond market volatility. The yellow line is basically emerging market bond spreads over treasuries, so how risky is lending to Argentina and the like. And then the green line is credit default swaps, i.e. credit markets. Price for perfection. As you'll see, it all gravitates from top left, bottom right. The world's fine. Then that's what happened next. So this is as of the end of 2008, when everyone realized that it wasn't all rosy in the garden. Fairly bad sort of spike there if you were on the wrong end of those trades. Here's what happened in the economy, savings rates. People stopped saving. And Mr. Rasmussen referred to those innocent people in Iceland. Bollocks. There were no innocent people in this credit crunch. Everyone was guilty. All those people with foreign currency mortgages in Latvia, that's not innocence. That's trying to pretend that there's free money on the table. So savings rates collapsed because we all knew that life was fine. And home ownership booms. Now, the thing with home ownership is you get to an average of sort of 64%. That's kind of where the US was, 64%. From 64 to 69% is the marginal buyer. It's people who shouldn't have owned a house. They shouldn't have been given a mortgage, but they shouldn't have tried to buy a house in the first place. They weren't socially stable enough, or they weren't economically stable enough. They weren't in a position to own a house. Yes, everyone wants to own a house. Not everyone can. I'd like to own a Bentley. I haven't got one. If I did have one, I'd have trouble making the payments. Equity withdrawals. Is it a house or is it a cash machine? Is it somewhere to live or is it somewhere that you're going to suck money out of to buy your Bentley? There's what happened in the US and the UK. Homeowners were sucking out the price gains and spending it, and refinancing their mortgages to spend it. They weren't refinancing to get better rates. They were refinancing to buy new cars and to go on holiday. Debt payments to income. How indebted was a US citizen? Very. They didn't have enough money to support the credit card loans and the other loans they were taking on. Foreign finance. How was all this financed? Well, particularly for the US, China. $1 trillion of foreign exchange reserves flooding into the Chinese market. So these are basically Freddie and Fannie Mae bonds bought. This is the foreign ownership of those. All of this growth in the US was financed by overseas bond purchases, most of it China. These are delinquencies and foreclosures, just in the US. The foreclosures is the white line and the red line is the delinquencies. And again, this is at the end of 2007. Are you really going to say nobody knew there was a problem here? Can you look at this chart and not guess what happens next? And at the end of the movie it's going to be bad? Don't believe it. Money market rates. 16 banks every day are asked, how much would it cost you to borrow money for 3 months? This is how LIBOR is set, the London Interbank Offered Rate. Everyone agrees, everyone agrees, everyone agrees, everyone agrees. Lehman is allowed to go bust. The worst mistake in the whole crisis, by the way, in my view. Suddenly, the banks don't know what the price of money is. Their guesses are all over the place. Now, if you don't know how much it should cost to borrow money for 3 months, and you're in banking, you don't know a lot. It's game over. You can't price collateralized debt obligations, or mortgages, or a loan to a company if you don't know what 3-month money should cost. If this is a Bank of England stress measure, and I'll gloss over what goes into it. It's things like bid-offer spreads, ratio of profits to leverage. There's a bunch of clever things that goes into it. When it gets to -10, a statistician told me that is, I think, 12 standard deviations. And I'm not very good at maths, but the way he explained it to me was, it's the equivalent of winning the lottery twice in a week when the lottery is only held once. That's how bad the market's got. This is what happened to global equity market value. This is every stock exchange in the world, total market cap of everything. It halved. Translation, this is people's pensions. This is real money. CDOs is virtual money. I don't give a toss what happens to Lehman CDO book. This is real money. This is people's pensions, what they rely on. If you're unlucky enough to be retiring at that tail end versus 2 years earlier, life's not good. This was what happened to a bunch of the UK banking share prices. They'd be living high on the hog for years, and then the market caught up with them. This was what happened to credit default swaps on governments, i.e., what is the risk of a default by Italy or Spain or the UK or the US or Germany, and also an element of what is the risk of them losing a credit rating? What is the risk of them being downgraded? What happened was bank risk transferred to public risk. This is public risk. This is me and you. This is what the banks did to us. They made our nations riskier. And I think I'll finish there because we haven't got much time. Thank you very much.
Super. Mark Gilbert, thank you so much.